Long duration treasuries TLT. Risk off, now up more than the S&P 500 risk on. Are you absolutely sure that today is bullish? CPI Tuesday before the market opened. Everyone was feeling at least a little surprised that we got another cooler than expected number. Of course, the market opened very green, up 2.5% on S&P 500. 20 minutes later, after all the retail traders bought in, it went up to 2.7%. If you would have bought it today at the open, you would have been trapped because it started to slide lower and lower after 10 a.m. Eastern Time. The reason why I am mentioning this price action is look at previous CPI days since October. It was always one big green candle higher. This time it was a gap and crap, even though we are still green at the end of the day. But we got rejected again at 200 moving average and the bear market downtrend line. Will the Fed talk the market down this week? Will the 50 basis point Fed funds rate change TLT's uptrend in a meaningful way? I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? Consumer prices climbed 0.1% in November from the previous month and 7.1% from a year earlier. The Labor Department said Tuesday, both down notably from comparable previous increases. Tuesday's inflation report is likely to intensify the officials' debate over whether to further dial down the size of rate rises to a more traditional quarter percentage point at their subsequent gathering January 31st to February 1st. Last month, Mr. Powell suggested the Fed was looking at inflation trends in three categories. First, prices for goods such as used cars that rose over the past 2 years are now slowly, sharply. Second, rents and other measures of housing cost that are still rising briskly but are expected to increase more slowly next year. Third, prices for services other than housing, which largely reflect businesses' labor cost. Mr. Powell identified the third category as the most important reflection of underlying price pressures. The labor market holds the key to understanding inflation in this category, he said. Wage growth hasn't shown meaningful signs of slowing down, particularly as companies offer higher wages to attract new workers than they do for current workers. Some Fed officials and private sector economists share concerns that another calendar year of high inflation could lead employees to seek and receive higher pay early next year, which could help fuel more inflation. My base case all along has been that inflation slows to around 3.5% to 4%, and then it plateaus there. And I don't see any reason to change that view. After Tuesday's report, such an outcome would likely be unacceptable to many Fed's officials. And while it wouldn't require them to continue raising rates aggressively next year, it would likely mean the Fed holds rates at a higher level for longer than many investors anticipate. A separate risk for the Fed is that signaling a further slowdown or a potential end to rate increases leads to a market rally that makes borrowing less expensive, stimulating rather than cooling economic activity and price increases. The Fed is raising rates to slow the economy through tighter financial conditions, such as higher borrowing cost, lower stock prices, and a stronger dollar, which typically curb demand and inflation. By one measure, the recent easing in financial conditions has been enough to offset the Fed's last two rate bumps. The markets are preconditioned to live with the fear of missing out on a rally, which can lead to exaggerated market gains that quickly get ahead of themselves. That conditioning probably needs to be broken a little bit. Inflation surprised on the downside. Both headline and the core CPI came in weaker than expected. Actually, only 2 of the 67 economists surveyed by Bloomberg expected a 0.2% or lower month over month core CPI print. What caused the surprise? Energy and related services dropped. It was expected, but not as much. Most importantly, the deflation in core goods, top right corner, picked up pace. For instance, used cars are now in outright deflation. In his recent speech, Powell divided inflation in 3 main categories. Core goods, he expects them to be in a disinflationary trend. Housing related, he knows it's going to take a while because of Calc's methodologies. Ex-housing core services, this really matters to him. This is because ex-housing core services prices are the least distorted measure of the really sticky inflationary pressures in the US. In other words, the type of inflation the Fed wants to go away. It seems like the massive tightening of financial conditions is starting to work its way through the core of the economy and dent inflation. The other important thing for the Fed is the breadth of the CPI. That's also declining. The share of CPI components running at 4% annualized pace has dropped from 75% to 60% pretty rapidly. While the absolute level of inflation is high, these 3 conditions seem to be unfolding. Sticky ex-shelter core services, CPI moderating, breadth of inflation receding, overall inflation momentum declining. This is good news for the Fed. But Powell will want to prevent a massive rally in stock and bond markets. The only mistake he wants to avoid is to prematurely let the inflation fight go. In the 70s, that was an expensive mistake. Now the issue is that keeping animal spirits at bay isn't going to be easy this time, as the evidence of a slowdown in inflation becomes more prominent. Also, inflation swap traders are pricing this path for CPI ahead. Have a look. Year over year, CPI priced at 2.5% in only 8 months from now. As the market cements its expectations for sharply lower CPI ahead and a subsequent Fed pivot, stocks and bonds are putting in a rally, but it doesn't look very strong. I think the Fed wants to talk the market down, but if the Wall Street trader wants to create a Christmas rally and get their bonuses, that's entirely up to them. Next year, it will be a deep recession just by looking at the fully inverted yield curve and the Tesla stock price chart. Wall Street wouldn't sell Tesla share if they don't have to. It really doesn't matter where the market is going this year. There will be a crash next year. And my client Teddy Eazzy's book, Wicked Pussy Perfume, it is an erotic novel. This is such an awesome book. Order your copy for Christmas. And my client Lee Vincent's book, The 3 Most Important Influencers You Need to Meet. Such an amazing book. And my book, Treasures Within Our Heart. This is my very first book. You are such a good boy for watching my video right till the end. Bye.